One of life's harsh truths that most of us learn the hard way. If something seems to be too good to be true, it most likely is. In business, this lesson often ends up costing businesses a lot of money. In the case of Luckin Coffee, statistics that seemed to be too great to be true were in fact false. While the business did not set out to scam investors, that is exactly what happened. If you don't know what I'm talking about, well, you're missing out on a lot of business drama. In this video, let us fill you up with all the juicy details. Hey everyone, and welcome back to our channel, the place for people looking to become financially smarter every week. Our goal is to explore the future of business and help you become a better investor. If you like our content, please give us a like and make sure to subscribe so you don't miss out on our new videos. Before we dive into the scandal, let's first learn more about the business. Luckin is a Chinese beverage store that mostly sells coffee and tea. It quickly grew after launching its first shops in Beijing and Shanghai in January 2018, adding 4,507 locations in the next 2 years. Two well-known companies invested in the business, hoping to benefit from Luckin's sweet promises: Joy Capital, one of the largest venture capital firms in China, and the Singaporean Sovereign Wealth Fund, GIC. Because of their investments, the company quickly achieved unicorn status. It went public in the United States in May 2019 and reported sales of $200 million in one quarter. As of the end of 2019, Luckin claimed to have served more than 40 million customers, making it China's biggest coffee store, surpassing its regional competitor, the queen of coffee shops, Starbucks. In order to gain market share, Luckin provided substantial discounts or free goods to customers who bought their products using coupons collected from their app. Customers may purchase products in either of these two ways. First, via third-party digital payment network like WeChat Pay or Alipay. Or second, by redeeming coupons through Luckin's app. According to the company, the income from coupon sales was estimated based on the number of redemptions rather than the number of coupons actually sold. Now that we got that out of the way, let's go into the interesting scandal details. Muddy Waters is a US-based financial research company that performs financial fraud studies. In January 2020, they got an anonymous report claiming Luckin's fraudulent behavior, along with supporting proof. They made this information public on their Twitter account but did not say where they got the anonymous tip. Luckin allegedly lied about their performance by inflating income, coupon sales, and redemptions. The report questioned Luckin's business methods and exposed the phony sales figures. According to the report, Luckin increased its sales volume by 69% in the third quarter of 2019 and 88% in the fourth quarter of the same year. The report also highlighted concerns about overstated revenue, fraudulent accounting methods, and senior management positions being abused, including Luckin's claim to have massive market share of coffee sales in China. Considering that the majority of caffeine consumption in China, like in most other Asian nations, comes from tea. Something does smell fishy. To understand the events better, we have decided Luckin's fraudulent schemes into three. For the first fraudulent scheme, Luckin started fabricating the number of coupons issued and redeemed by individual consumers in April 2019. To buy coupons on Luckin's app, some of Luckin's workers, their families, and other connected businesses moved money from private bank accounts to WeChat Pay or Alipay accounts. They then redeemed the vouchers and placed fictitious orders, thus artificially inflating sales statistics. In the first scam, more than $1 million in sales were faked. It's unclear if Luckin returned the money to the workers in order for them to buy additional coupons, but one thing's for sure was aware of the phony income. For the second fraudulent scheme, workers at Luckin started selling vouchers to fictitious corporate clients in May 2019, who were really connected to Luckin employees. To purchase coupons, corporate clients would send money from their company's WeChat Pay or Alipay accounts to Luckin's app. These phony coupon redemption requests, like the first, fraudulently boosted sales performance. In the second plan, about $10 million in sales were manufactured. However, it's unclear if Luckin returned the funds to the workers. Next, the third fraudulent scheme, which began in May 2019, involved Luckin workers fabricating the number of vouchers sold to third-party shell businesses. The vouchers would then be resold to individual consumers by these shell businesses. Because they didn't make genuine orders or use the discounts, it's probable that these customers were also workers. These shell businesses that sent money to Luckin were set up and managed by some of Luckin's employees or their associated firms. Employees would then alter the sender's identity on Luckin's bank statements from the financing business to the shell company. Employees at Luckin's would redeem coupons and place fictitious orders, inflating coupon sales and income. This made up the largest portion of fabricated revenue, approximately 80% of the total $311 million. The source data was moved from the real company operations database to the created database by some Luckin employees. Reports used in the preparation of financial accounts and accounting are examples of source data. Because Luckin's finance staff could only access the falsified database, the anomalous transactions were unnoticed. Now, let's analyze the ethical issues involved in the Luckin scandal. Luckin's ethical failure was its management's deliberate misrepresentation of the business and production of fraudulent accounting papers in order to deceive investors for their personal gain. Ethics analyst in this case includes all levels of a company, including senior management, the board of directors, audit committee, internal auditors, and external auditors. While discussions are related to conflicts of interest, dishonesty, abusing positions of power, and failure to fulfill fiduciary duties. Fraud is typically the result of the actions of many people, including top management, frontline employees, internal auditors, and external auditors. However, it is the responsibility of the management to guarantee that the company's ethical standards are upheld. Several moral agents failed to fulfill their moral duties in Luckin's case, resulting in an accounting scandal and fraud. Internal pressure to achieve unrealistic sales goals via coupon sales and redemption, irresponsible corporate management providing the potential for fraud, and rationalizing it was okay to falsify financial statements to fulfill targets were all factors in Luckin's case. So, what happened with Luckin after the fraudulent acts were uncovered? Luckin's actions have been investigated by the U.S. Securities and Exchange Commission, the Chinese Securities Commission, and China's State Administration for Market Regulation. The U.S. SEC determined that Luckin's action constituted fraud. After that, on April 2, 2020, Luckin stock dropped 81%. The trading of Luckin shares was temporarily suspended and reinstated on May 20, 2020. Luckin also launched an internal investigation and stated in April 2020 that more than $300 million was fraudulently obtained in 2019, and that the relevant public financial records should be disregarded. 12 workers who worked with the CEO and COO were dismissed as a result of the three schemes that we mentioned earlier, and Luckin CEO, Jenny Zia Kian, was fired by July 2020. Additionally, evidence suggests that the business that bought the vouchers indeed had ties to the chairman. So in July 2020, the chairman was fired. Luckin was accused by the SEC of making false claims about sales, expenditures, and net loss from April 2019 to January 2020 in order to mislead investors about Luckin's financial performance. On December 16, 2020, the SEC completed its investigation and issued a penalty against Luckin. They eventually agreed to a settlement that included permanent injunctions and a $180 million monetary penalty. Attempting to recover from a $100 million fine, they filed for Chapter 15, bankruptcy protection, in New York on February 5, 2021. Luckin said that bankruptcy proceedings would not affect everyday operations and that it would continue to fulfill its commitments in the usual course of business, such as paying suppliers, vendors, and workers. The company is in discussions with its stakeholders about restructuring its financial commitments in order to improve its balance sheet and allow it to emerge from the Cayman proceeding as a going concern, which will benefit all stakeholders. The relief sought in the Chapter 15 petition is critical to the company's reorganization. This relief will facilitate the company's reorganization by allowing cooperation between the Cayman Court and the United States Bankruptcy Court to safeguard stakeholders' interest while enabling the company's reconstruction. All of the company's shops in China are open for business, providing high-quality, affordable, and convenient goods to its consumers. The filing of the Chapter 15 petition is unlikely to have a significant effect on the company's daily operations. As they said, nothing has changed. They're in the usual course of business, continuing to fulfill their trade commitments, including paying suppliers, vendors, and employees. What do you think of this story? Did Luckin get what they deserve? Was it necessary to fire the employees even if they might just have been following orders? Let us know in the comments section below. That's it for this video. Thank you for watching. If you liked this video, we got a lot more in store for you. Don't forget to give us a like, subscribe to our channel, and click the notification bell so you'll be updated in our future videos. I'll see you next time.